Hi, everybody, and welcome to another edition of the Banking on Innovation podcast. I'm so excited to bring you today a different kind of discussion on innovation. You know, as a country, an administration, a banking industry, and as individuals, we all have a vested interest in climate sustainability. And so today I'm pleased to welcome Chris Creedy, the Chief Investment Officer of the Department of Energy's Loan Program Office, or LPO. And Chris plays a vital role in helping the LPO make decisions that deliver high impact for the future of our country around sustainability. And he joined LPO from Goldman Sachs, where he managed over $75 billion in assets. So, Chris, welcome to the podcast.
Jody, thanks very much for having me on.
You know, I was kidding with Chris beforehand that many of our guests, I have a pretty good understanding of what they're going to talk about and the messages they're going to deliver. But I'm fascinated to learn more about how the entire industry can lean in and really step up in our advancements around climate sustainability. So thank you again, Chris.
No, I'm excited to share what we're doing at LPO to give you a perspective on how the financial markets and the public sector can work together. And it's just a great opportunity to chat about a super important topic. So thank you very much.
Yeah. So, Chris, some in our audience, maybe even most, may not be aware of the mandate or the importance of this three-letter acronym LPO. What is the LPO, and why is it so important in the sustainability movement?
Definitely. The Loan Programs Office was established actually back in '05, and we administer a number of different loan programs. So for the purpose of this podcast, we'll sort of aggregate them together. But as our applicants know, there are actually some fairly unique differences between the 5 programs that we administer. Each of the programs basically has the same idea. We offer senior debt to projects and companies in the energy space. The idea is that if we can help solve the financing problem for these projects, we can help commercialize technologies and projects faster than the private sector would without our help. And we think that we have that competitive advantage of the national labs, the 10,000 scientists and researchers who can help us de-risk certain risks better than the private sector. And thus far, it's been a relatively successful program. During the great financial crisis in '08, '09, '10, '11, the LPO had its sort of first big push of loans. The program had a good amount of success. Our realized default percentage is about 3.4%. At the time we made those loans, we thought they would be about 8%. And so we've actually outperformed what we thought we were going to do. And now with the passage of IRA, and I'm sure we'll get into that later in your podcast, we have a new surge of loans that we're anticipating coming. And it is our intention to underwrite those loans with the same rigor that we did the previous set.
It's very impressive. And as you were alluding to, the LPO has really been supercharged the last few years as part of the current administration's clean energy ambition, and even bringing on very experienced and learned people like Jigar Shah as the director and yourself as the chief investment officer as well. But people may not know that historically, the LPO played a vital role in key technologies, even early at its incipience. And many may not know that you played a vital role in the early success and survival of Tesla. So what are the sectors in which LPO focuses on now? And why have you chosen these specific categories?
Yeah, no, I mean, I think that that's actually a good point. So 08, 09, 10, 11, as you mentioned, we were a debt investor with Tesla. We were also extremely active in the early stages of utility scale solar, trying to figure out how to increase the amount of solar energy production in the U.S. at utility scale. Fast forward about a decade, a little bit more, and that is a relatively bankable product. And so the kinds of technologies that we're looking at now share the characteristics that the technologies that we invested in 12 years ago have, namely that they're a little bit early stage. So we're looking at a number of different technologies, whether that's offshore wind, onshoring, reshoring, and friendshoring, battery chemistries for the battery supply chain for electric vehicles, trying to figure out how to engage in advanced nuclear, virtual power plants, and the connectivity of homes and buildings to grids to allow for bidirectional information exchange. I'm sure I'm leaving out a bunch of different technologies, geothermal, battery, utility scale battery storage. There's all kinds of really interesting technologies that are out there, all of which sort of share the similar characteristics that the deals 12 or 13 years ago shared, which is they're a little bit early stage for broad bankability. And so you'll often hear Jigger talk about this bridge to bankability that we're trying to help technologies and projects cross. And that's exactly what we're trying to do. Figure out ways to provide debt financing to technologies to help spur the commercialization such that when you and I are talking in 2035, 2036, these technologies have been readily banked and we've moved on to the next set of technologies.
Intriguing. And, this is all within the backdrop of, let's call it a kind of a fascinating environment right now where so many things are in motion and new macro trends are developing. I'm curious from the LPO side, what are some of the key macro trends or development, let's say even over the past year, that are relevant? And how has that evolved your priorities, processes, pace of investment, and efforts?
There's a number of different, macro developments that we're paying attention to. I think I'd be remiss if I didn't highlight some of the concerns that the banking sector has had over the past 3 or 4 months. That obviously affects a lot of listeners to your podcast. And if I'm being blunt, like the change in credit spreads and the widening of credit spreads has made our program disproportionately more attractive to some borrowers. Many of our borrowers really couldn't access broad financing at anywhere near the rates that we can offer anyway. But that sort of chilling effect of the banking sector certainly has been something that our applicants have noted. Away from that, though, there's an enormous desire to onshore a lot of the supply chains. And so if you look at the early transactions that have come under Secretary Granholm and Jigger's watch, you'll see a lot of EV battery supply chain and component transactions. And the idea is that we're trying to onshore a lot of that supply chain, whether that's the first ever anode assembly facility in the United States, whether that's a significant investment in cathode, both assembly facilities as well as recycling. And then, of course, the OEMs and the EV battery assemblers themselves. So as we think about, what do we see and what are we preparing for? Certainly, a significant amount of EV sales as a percentage of total car sales, over the next 7 to 10 years.
It's very intriguing. You talked about, Chris, that LPO is positioned as a bridge to bankability because you're actually taking on market risk, technology risk, commercialization risk. So even more impressive, the kinds of loss rates that you've had. But let's discuss now and transition to the role of the banking industry in climate sustainability. Project, if you would, because I know you probably like to help forecast what's coming. And it's difficult to predict. But how would you lay out kind of a 3-horizon path? What should banks be doing right now? What should they be preparing for in the next kind of 12 to 24 months? And then what would you like to see as an aspirational role for the industry around climate 24 months plus? Easy question, Chris.
Yeah, no, it's I, the what should they be doing now question. There's there are a number of investable asset classes right now that banks should continue to bank, whether that's utility scale solar, whether that's opportunities in the consumer space, which we'll get into in a second. To the extent that banks feel comfortable with certain technologies now, they should continue to bank those. I certainly understand the desire to say, okay, well, what's the next 12 to 24 months going to look like, and what's going to look like after that? I think that we should, whenever we're doing forecasting, remember to take a nice healthy dose of uncertainty. There's a lot of paths in the future, and exactly how this is going to go, we don't know. But I feel like if we do our job correctly, we're going to help de-risk certain technologies, and that will allow for follow-on projects and companies. And it would be great if the banking sector stepped in to provide high-level senior financing to those sectors. I would also hope that as we move forward, that we can continue to collaborate with our financial partners, with our financial industry partners. That could really take a number of different flavors. I could easily see us being co-investors. We provide debt, Bank X provides debt. I could see us being a guarantor. In addition to compelling the United States Treasury to make a loan, we also can guarantee a loan from a private bank. So one of the things that we are looking at are partnerships, ways to work with banks to see if we can de-risk through our guarantee projects that they're actually very excited about. And so when we're talking with our financial institution partners, we're trying to bring up all of those conversations and say, hey, what are you seeing? What are your clients seeing? And how can we work together to sort of solve those problems? Because again, high level, our ultimate objective is to not only pull forward as much capital expenditure in clean energy as we can, but to really catalyze that deployment and investment in these emerging industries, which we think are absolutely critical for decarbonization.
You know
And
what I
then
really
24 months. Sorry, Jody. 24 months from now, it's really hard to say, but I'm hopeful that we've succeeded. And and that whatever the next technology is, we've de-risked it enough, or we've induced enough capital to be formed in that industry such that the banking sector is ready and available to bank it, and they are just part of the financial ecosystem without our assistance.
You know what I appreciate about what you said? The perception, let's say, would be that, okay, governmental programs, fairly rigid, bureaucratic, you have to fit within a box. Everything you talked about, Chris, was actually adapting to uncertainty into a world where we're making bets. And we also need to adapt not just the kinds of investment profiles, which I know you look closely at, but even how you work with an ecosystem. So I can really appreciate how that's been maybe as a centerpiece of the program, which is this is a model, a program, an entity which will need to adapt to be able to drive maximum impact. It actually may look different in terms of composition a few years from now, depending on how things play out.
Certainly hopeful. I mean, and especially as you go further and further out, the composition of the technologies will change, and the needs of the financial markets will change.
Yeah. So, Chris, let's shift now to the actual behaviors of the end customer, consumers, small businesses. I'm curious as to your point of view here, which is how do you think that banks can help consumers, small businesses better align their purchasing activity with their personal values. Let's say climate and sustainability is very important to a growing segment of customers. How can banks help them better align those values and encourage certain kinds of behavior around their spending and their savings?
Jody, I think this is one of the most important topics that we could talk about. There's an enormous amount of CapEx that's going to need to be spent in the residential sector over the next 7 to 10 years if we're going to achieve our climate objectives, our 2035 and 2050 climate objectives. And, rough numbers, buildings represent something like 40% of emissions in the United States. And for us to seriously reduce those emissions, then we're going to need to see investment in those buildings starting today. So on the residential side, the LPO announced their first consumer-related transaction about a month ago. We're using our guarantee authority to help induce a behavioral change in the residential solar market. Namely, we want the inclusion of virtual power plant, VPP, technologies to be in every rooftop solar, every battery that's installed, because we fully believe that one of the biggest issues that we're gonna face as a country is the more and more solar and wind projects as a percentage of the energy produced in the United States increases, the more we need the use or demand of electricity to itself be a function of the supply. And in order for that to work, we need VPP technologies, grid interactive buildings of the future. And so that technology is relatively nascent. And so if we're going to get to where we want to be in 2035, we need to help induce that behavioral change. And so this is sort of the first of what we hope is a good number of transactions where we're helping the consumer get access to and induce the behavioral change such that they buy these technologies. So another example of this kind of technology would be heat pumps. So if we could figure out a way to induce the purchase of heat pumps as opposed to traditional HVAC, that's another way that we can help electrify the home. And even better, if those heat pumps had bidirectional technology such that they could ask the grid, hey, what temperature should I be at right now? And the grid says, it's California, it's summer, it's 1 p.m. We have a lot of solar, energy's really cheap. Why don't you drop your temperature a little bit more than you would normally? Hey, it's 5 p.m., it's 6 p.m. in August. The sun's at a lower angle. Everyone just plugged in their EV. It's really taxing on us. Do you think you could calm down for a couple hours? And have that all happen without the consumer being bothered because it's all done by software. That would be amazing. And so for us to get there, we need to make some investments today. And so the banking sector, the government and public sector, the technology sector need to work together to figure out how do we get that technology into the homes? Because, every HVAC that's sold is 15 years before that home is going to invest again in that capital expenditure. And so these are things that we really need to think about today and sort of start getting on that right now.
Exciting things to take on. So in the same vein, maybe we can pull on that a bit more. Consumers and small businesses and businesses, they have a close relationship with their money that banks help them with money management tools. How's my spending doing? My cash flow? Do you envisage a model where customers can have a close affiliation through like the equivalent of money management tools around their sustainability impact, where banks can actually give them tools to understand their purchasing activity? Are they buying from the merchants that have strong ESG considerations and scores? Can you help us think about what role can can the banks have in putting more of these tools in the hands of customers so they're making better decisions?
Yeah, I mean, there's a number of different things. You mentioned a few, and I will amplify those to the extent that there are scoring or information regarding the correct purchases or the optimal, let me use a different word, the optimal purchases for the home to reduce the impact on carbon emissions. Having the banks be partners with us in disseminating that information to their customers would be great. One of the biggest costs of the capital expenditures or the equipment that sales. Let me try this. One of the biggest issues in getting the right distributed energy equipment into residential homes is the customer acquisition costs. And the banks have the customers. And so to the extent that they can partner with us, with other institutions, to lower that customer acquisition cost and get the right optimal equipment into the homes, that is a really good first step. One could imagine better steps or later steps being differential borrowing rates. This is where we think we can help step in and say, hey, if you're going to buy the optimal equipment, we'll help the bank or we'll help the lender by using our guarantee authority to help reduce the cost of borrowing for that institution, such that the end consumer is able to borrow at a more attractive rate if they are using it to finance the optimal equipment. And that's kind of what I mean by the behavioral change that we're looking to induce. And there's nothing really stopping the banks from doing that right now. Like that would be amazing. So there's a number of different tools, I think, in their toolkit. And I think from my perspective, it's just an invitation to roll up your sleeves and whiteboard out, like, how can we work together to accomplish these very important objectives when it comes to the consumer.
Yeah,
We've talked a lot about the residential side. I don't want to leave the commercial side. The
please.
Banks and the insurance companies also have a really important role in the financing of C&I buildings, of commercial buildings. And so on the commercial building side, when you buy a commercial building, the CapEx is usually in the model. And so, here, again, they can play an important role by saying, what are your CapEx assumptions for this transaction? Oh, I see you're not putting in EV charging in the parking lot of your grocery store. Or, oh, I see you're putting on a new roof in 3 years. Are you also putting on distributed PV? I see you need to change your HVAC system. Have you thought about electric heat pumps? So there's a number of different things that on the lending side, for especially the commercial real estate side, that we can see banks leaning in. And then on both the resi and the commercial, having the appraised value of the home fully incorporate the energy costs, energy burden, potentially climate costs, as they figure out what is the value of that property. That'll go a long way in the transparency that we need as consumers or as financial market participants to fully sort of see all of the different implications.
Per your comments, Chris, even though we're operating in a fairly uncertain and let's call it rapidly evolving environment, what you're pointing to is actions that can be taken that can both have near-term impact, but also can create learnings or put the industry, the customer in a better position moving forward through those learnings as well.
I think so. And Jody, can be done now. These are real opportunities for all of us to work together to try to start making the investments that are made every year in the I think the number that I saw is in the next, I think, 7 or 10 years, something like $2 trillion of capex is going to be spent on the residential market, and we have an opportunity today to help turn most of that into optimal investments for the climate, for addressing this climate crisis. And so, how awesome is that? So let's work together and try to figure it out.
Yeah. It's interesting. In some ways, it's also changing the dynamic or the relationship between the bank and the consumer, or bank and small business, or bank and commercial customer, by educating and informing about your purchase activity and about actions that you can take, either merchants that you can work with or solutions that you can put in place to improve your sustainability, or changing the way that you evaluate risk or giving incentives in certain ways. In many ways, it's actually changing the dynamic around, beyond just money, having the bank play and the banking industry play a central role in how consumers, small business, commercial kind of adapt to, I'll say, tactics, purchases, solutions that can really advance the entire climate sustainability sector.
Yeah, I'd add to your list utilization of tax credits, both on the federal side and the
Ah,
state side. These are
yeah,
very complicated things, and the banking sector can provide a lot of demystification, especially to the individual consumers,
yeah,
and help them understand all of the different programs that are out there.
yeah. That's actually a great one. We even, since banks can really understand purchase transaction activity, if you can see, for instance, just around what your gas spend may be, what your heating spend may be, you can translate for a specific customer not just the benefits of the movement towards green, but even the kinds of incentives that they may be able to benefit from, where it's both an education for the customer, and also for you as a customer, you will likely save this much through the combination of energy savings plus tax incentives. And it's complicated, right? So that's actually a great point, that the industry can play a role in the informing education, and in some ways kind of optimizing at the household or the business level.
Yeah, and energy burden, the cost of heat, electricity, the energy burden in a residential home has less impact on the valuation as that same burden does on the commercial space. So I do think that more of this data coming out, and the aggregation of this data and the analysis of this data, will actually help the banks in their risk management as well. If the banking sector holds a ton of mortgages, and understanding the the consumer's energy burden as a as a as a factor in that analysis is good for the banks. It's obviously good for the consumer if we can figure out a way to reduce that burden, and it's good, and it meets our climate objectives of trying to reduce carbon. So there's a number of different win-wins, especially in the real estate space, that I think the banking sector can really play a huge role in helping us find.
My firm Personetics is also excited to weigh in here and lean in around delivering sustainability insights that can help customers better manage their spending. But we know that this is actually just the early innings. There's so much more that the industry can do, and we're excited to be a part of it. So, Chris, let me end with our the question I ask all our guests, but I do want to orient it more towards specifically your role in the LPO, which is, for the sake of the planet and sustainability, what do you think is required of banks and credit unions in the next 3 to 5 years that the industry may not be well prepared for right now?
So one of the things that I think we need to think about is, as we are moving forward as a broad energy finance community, a lot of the energy investments that we're talking about don't really fit traditional large pockets of investors. Vanguard and Fidelity have very specific rules around what their mutual funds can buy. The large banks, especially the SIFIs, the strategically important financial institutions, have rules from the New York Fed as to what their portfolios can look like. And so, speaking in particular to your advisor community and the investment banking community, figuring out ways to help the energy market mature these projects and companies faster than we are maturing companies normally. You know, the textbook example, if you were to go to business school, right, is you have your startup gets some sort of venture funding, it sells to private equity, it gets a turn of leverage from the private debt markets, it then can IPO, it's a below investment grade company, it gets high yield debt and eventually becomes investment grade debt, and then all of a sudden it's in the S&P 500 and it's a mature company. And that takes a long time. If we can figure out a way to access those large pools of capital, the broad stock market, the broad debt markets, the bank loan markets, faster, will help unlock a lot of that spending. And so working with the financial institutions, working from all the way from the venture funds, all the way through the private equity, through the money managers, figuring out ways to mature these companies faster, I think will be important. And I don't necessarily have any of the solutions for that, but I do smile when I hear large pockets of money CEOs saying X trillions of dollars of my fund or my entity or my institution will be in the climate investment sector, but don't talk about how they solve that maturation problem or accelerate that maturation such that their funds are actually eligible to make those investments. And so we want to work with all of those institutions and try to help figure that out, because that has to happen in order to unlock those really large pools of capital.
Well, Chris, you've given us a lot to think about, and I'm so pleased that you decided to join us on our Banking on Innovation podcast. You know, it brings a completely different lens to innovation or customer-driven innovation, but one that's so vitally important for the administration, for the industry, for consumers, businesses, and the country as a whole. And I'm thankful that people like you have stepped into to governmental positions, bringing all of your experience, you and Jigger and many others, and are really powering this forward on behalf of the country and on behalf of all of the innovators out there that are really trying to make a difference around climate sustainability. So I applaud your efforts, and I hope that that many will heed some of your comments and your asks.
Well, Jody, I really appreciate it. If I can maybe end with this, my experience at the Department of Energy has been phenomenal. The vectors, the headwinds and tailwinds, I kind of got right. I was going to get a lot of utility from saving the polar bears, and I was going to get a little bit of headwinds from government bureaucracy. Maybe I was off on the magnitude of both, but by far the tailwinds have just greatly outweighed the headwinds, and it has been a wonderful experience. The people at the Department of Energy, especially at the LPO, are phenomenal. They are really great partners to work with, and I would encourage any of your listeners, to the extent that they have the public service bug, to really think about it, because I think it is really rewarding. And especially right now, at this point in time, given the mandate that we have from Congress, given the importance of climate investment in the world, and the opportunity to be at the center of the commercialization of all these technologies, it's a lot of fun. So I really do. I really appreciate your comment, but I'm having a blast, and I know that that my colleagues at Energy are as well.
Well, I know I'll get a lot of great feedback and responses. You've given some very thought-provoking ideas, and I love the not just the work that you're doing now, but also the ambition that you're setting, not just for the LPO, but really one that our entire banking industry can embrace and move us forward on something that's so important for the planet. So thank you, Chris. Really appreciate it, and I wish you the best because we all have a vested interest in it.
Thanks, Jody. Appreciate you having me on.
Thank you for joining another episode of Banking on Innovation. Make sure you subscribe to get future podcast episodes or follow us on Twitter @Personetics or on Personetics.com.